What has been your one money mistake?
Borrowing to invest.
Welcome to yet again another episode of Pesa Talk. I am excited. Today is a very special day. I have a special guest in our studios. We are going to delve into investments, and I'll give an opportunity for my guest to introduce himself. I do not want to mince my words. Please introduce yourself.
Thank you very much, Paul. Good, is it evening or good morning, depending on at what time you are watching. My name is Elijah Mucunguzi, and I am an investment and wealth management specialist with over half a decade in the financial asset management space, and majorly into treasury bonds, treasury bills, unit trusts, and anything investments. So I'm here to share my experience and knowledge with you, and stay tuned.
Perfect. If I were you, I would pick my pen and paper and get ready, because class is about to be in session. So Elijah, I'm first of all very excited about what this conversation is going to look like. I know myself, I have a few blind spots around your areas of expertise, but nonetheless, let's start very simple. What are government securities?
Thank you very much for that. To just put a bit of context in what government securities are, so governments worldwide usually have budgets that they release every year to run their government. So government projects and governments, different things that the government is trying to run that financial year. So to bring it back home, Government of Uganda, every year, particularly in the month of July, June, July, they release a budget, okay, the government budget. So the finance minister will come out, will say that, okay, Uganda wants to run, we need about 72 trillion to run the government projects for this financial year. Now, governments usually have basically three ways on how they raise funds, okay? So we have either through taxes,
Okay.
what we call public debt and foreign debt. Now, on the side of the public debt, what happens is government is going to come and say, okay, we have a budget of 72 trillion. However, this is just majorly on paper, okay? We need to raise these funds. We have raised probably partially some of the money in the taxes. However, we still have a big budget to finance. So what will happen is they will go to the central bank, that is Bank of Uganda, and request Bank of Uganda to come out to the public and auction and tell them that we would like to raise, let's say, 1 trillion shillings this month to run a certain government project. Okay? So when that happens, central bank will then go through your banks, okay, your commercial banks, and auction those what we call a bond, okay, or a treasury bill, and that is when they are able to borrow this money from the public. So to narrow it down, a treasury bond or a treasury bill is basically government borrowing money from the public. So it's just a tool that they use, but it's through the central bank and through your commercial banks too.
So it's a mechanism of government project financing. I heard you mention something, auction. Is there like a market where people come and say, this is what I'm offering? How does that auction happen?
So to break it down and make it easier, every asset, just bring it back home like into land, yeah? Yes. Land, or let's take it to cars. Cars have where you can go to a car bond and you are purchasing a car. So you could either buy brand new, or you could buy already used. Yeah. Now, in the treasury bond side, it's literally the same thing, okay? So we have what we call the primary market. The primary market is where the new bonds are being auctioned, okay? And then we have what we call secondary market, is where already existing bonds are being sold. So take the primary market like a place where the new securities are coming into the market, and the secondary market where already existing bonds, already existing assets are being sold. It's as simple as that. So one can choose either to go to the primary market, which happens once every month, and it is on a Wednesday when it happens. Yeah, it happens on a Wednesday, but once every month, that is when we have the primary markets happening. Then the secondary markets are always open every day of the week. So long as it's Monday to Friday, the market is open for you to come and actually buy. Saturday and Sunday are off days, the markets are closed. But Monday to Friday, markets are definitely open for you to buy.
So where do I go if I want to buy a bond for a layman?
Okay, so if you want to purchase a government bond, so there are two places you could go to. Number one, it is to your commercial bank, whatever bank you're in. As long as it's a commercial bank, that you're able to buy a treasury bond from them. Or number two, you're also able to go to what you call your stockbroker. Okay, so you can just go to the Capital Markets Authority website. There are licensed stockbrokers that are there. They're also able to help you purchase your bond.
Interesting. So is there a preference for when I should go to the primary market or secondary market? Are there anything I need to, what would take someone to secondary market, for example?
Okay, so primary markets are where the new bonds are being auctioned. So what happens there is that with the primary market, the bond is new first of all, so it doesn't come with an interest rate attached to it.
Okay.
So take it like a sort of a gamble. You're bidding, okay? So you could have Paul is bidding that a 20-year bond is going, I want it to get it at an interest rate of 18%. Then Elijah comes in and says, no, I want that 20-year at 16%, okay? So based on how the government sees how the auction is going and how the bids are going, they will then select which bid will win, okay, based on literally market, how the market is actually performing and how the market is bidding, okay? Then afterwards, they will come out and say, based on this and this is the interest rate we are going with this particular treasury bond.
Okay.
Yeah, but something about the primary market that is unique is that it's not necessarily that every bond that comes there is new. So we also have old bonds but are being re-auctioned. In the market, they call it a reopening. So a lot of people will see it on the government, on the BOU website, that it's a reopening. It means that bond is already existing. However, they are auctioning more of it. They already auctioned probably 1 trillion of it, but then they're saying that they need more of that particular bond, so they're going to come out and request for more funding. Yeah, that is why you keep seeing reopenings coming in. Yeah, and most of those reopenings already, of course, have their interest rate set. But what will make it slightly different, or now to make it a bit technical, is what we call a yield. Okay,
that's actually something I wanted you to give a bit of time.
Yeah.
Price, yield, and interest rate. Those three, how they are interchanged in the bond market. As a layman, someone watching this show today, where should they put their focus when going to the market? Should they be looking at the price? Should they be looking at the interest rate? Should they be looking at the yield? What exactly should I focus on as a layman, if it's too technical for me to understand?
Okay, so where you should focus. Now, this takes me back to the first question you were asking about between the primary market and the secondary market. Now, I just partially answered what happens in the primary market. Now, in the secondary market, prices there are already set.
Okay.
Okay, the interest rate is already set. You're already watching the movements in prices. Now, one thing people should not know is that prices of bonds change every single day. There is that movement. Now, I'm going to explain it and also answering your question on that, on what people should look at. Yeah. So, secondary market, if you're someone that wants something already set for you, you can already make a decision based on what you're already seeing. The secondary market is the best place for you to go to. But primary market, I would want to say it's also a gamble in its own way, because you could put in a bid and be rejected. We have seen bids being rejected on the primary
that also
market.
happens.
Yes, a lot. It happens a lot. For example, we had the 25-year that came out last year.
Yes.
We had a lot of bids that were rejected because a lot of people were putting in bids that were requesting for 18-20%, but government ended up taking 16%. So whoever bid it above a 16%, automatically
rejected.
your bid was rejected. Yeah, so that can definitely happen. So what then can one look at in terms of making a decision in which bond to actually look at? So number one, you need to look at what we call the YTM, or yield to maturity. Okay?
Yeah.
Now a yield to maturity is okay, the interest rate that you will get if you hold a bond till
maturity.
Yeah, till its maturity, or when you get your principal back, in simple terms. But it's also a reflection of how the market is awarding that bond. Okay? So for example, a bond can come out, to bring it here into context, a 20-year bond, right now its fixed coupon rate, or its fixed interest rate, is 15.8%.
15.8, okay.
However, we then have what we call a YTM. Now the YTM in most auctions comes out at a 17%. Okay? Most of the times it has been coming out at around 17%. What that typically means is when your yield, when you find that a yield is slightly higher than your coupon rate or your interest rate, it means you're going to get that bond cheaper in the market or at a discount. Meaning someone with, let's say, 100 million or 50, or let's say 100 million,
yes, would
come into the market, and instead of them paying 100 million, they are paying probably 90 million, and they're getting an extra 10 million as a discount on it. Or the other way is, one thing about the yields is also it can also become very expensive in the market, because the moment it drops below the coupon rate or the interest rate, okay, let's still now assume the 20-year, which is at 15.8. If you drop to, like, let's say 15% as the YTM, it means that bond is going to be expensive. You're going to overpay to get something the same value. So for example, sticking with 100 million, you're going to find that you have to pay an extra 10 million to get something worth 100 million shillings in the bond. In the bond market. So
you're buying it at a premium.
You're buying it at a premium. It's what we call a premium bond. Yeah. So it's not that necessarily they are bad. There are factors that influence it. For example, what we call accrued interest. Now that bond has accrued a lot of interest that the yield has also slightly dropped. It can be a bit confusing, but this is where now you actually need an advisor to come in and help you, try and make you understand what really happens. But yeah, sometimes accrued interest plays a big role in how the pricing literally changes in the bond market. So in the you know how a bond is, like, for example, land. You bought land today, so it starts to accumulate value over time.
Yes.
Same thing with a bond. The moment you buy it, it's accruing interest every single day. So if you bought a bond towards, let's say, a coupon payment date, you're most likely to pay more, because this thing has accrued interest. They won't give you this interest for free. You have to compensate the person that was holding it.
Okay.
Yeah.
That brings me to something interesting. Coupon payments. When you say, if from picking up from where you just stopped, how are these coupon payments structured?
Okay, so these coupon payments are structured in a way that they have to align with the maturity date. Okay? Bond, so coupons are paid every 6 months for bonds.
Okay.
Okay? So for example, a 20-year bond and a 15-year bonds are paying in the month of January and July. Yeah? So they keep on going like that, but there are certain instances where you even see that after a few years, the coupon payment months change because they have to align with the maturity date. Yeah? So the maturity date is the one that determines how the coupons are being paid. But overall, just know every 6 months, the coupons are coming in, and they're already predetermined. So when they're auctioning these bonds into the market, they're already telling you that on this date, you're going to get your coupon payment. Yeah. So, for example, in January, we had over 400 billion that was paid out in coupons for both the 15 and the 20 year. Yeah. So people that were holding that 15 and the 20 year last month were literally in January were having at least some good cash
Yeah.
to clear some of their, expenses during that time.
In terms of the marketplace, bonds have really been treated as institutional investments. From where you sit, I know Ugandans have really picked up on the conversations around government securities. From where you sit, are you seeing a lot of retail investors interested into buying the government bonds and bills?
Interesting. Let me give you a bit of history of government securities. So in the 1980s, Uganda's economy was basically characterized by war. By then, our economy was very unstable because we're just in the war part and we're also coming out of war, transition of power and etc. Now, early 1990s, our economy was not strong enough and our tax base wasn't that big enough for it to sustain the economy or run the economy. So the government had to come out and ask itself, how then can we run this economy? How can we raise money to run this economy? So fast forward to 1992, we had our first introduction of a treasury bill. Okay?
Yes.
So the treasury bills came in, and these were just financing short term. Treasury bill, you're financing either 91 days, 182 days, or 364 days. So it's either 3 months, 6 months, 12 months,
12 months, yes.
in context. Okay? So it was doing quite well, but when they had just introduced them, it was only banks and big institutions that were more of allowed to bid and buy these bonds. Okay, so it wasn't like sort of a public thing. Yes, under our laws, public could, but it was a new thing.
The interest wasn't as high.
So people weren't really so much into it. So it was only basically the banks and big institutional players that were in. So fast forward into the early 2000s, okay, we then had the treasury bonds coming in. So government was asking, okay, we're having short-term debt, but our economy needs to keep running. We can't keep financing short-term debt. Every 3 months we are paying off. It will become unsustainable in the long run. So they had then to introduce longer-term debt, okay, from 2 years, 10 years, 15, etc. That is when the bonds came in, okay? And in 2000s, we then started seeing rates going at about 9% to about 10%, or averaging around there for the treasury bills. Now, when the bonds came in, we started seeing interest rates starting to grow up and grow and grow. And then in what happened was we had a sort of a change, a dynamic change in 2019, 2020.
Yes.
Because what happened there, we had COVID coming in. Now, a lot of people were not allowed to do sort of businesses. Businesses were down, but people wanted to place money somewhere for it to grow. Now, that is when the industry started to grow. Started seeing the unit trusts growing, the treasury bond market growing, because now people had started now learning about the treasury bonds and bills. So a lot of people started injecting money into the government, because even the government needed money at that time to sustain the economy. So there was a huge injection. We started seeing bonds becoming more popular with time. We then started even seeing yields going up in 14s to even right now 18%. Yeah. So that has really caused a whole sort of growth in our industry of the treasury bonds and bills, but also that is how a lot of individual players have also come in to invest in this industry.
And I also think the government has done a lot of work in terms of sensitizing Ugandans to appreciate these smart investments. They've become an option to you opening up a shop. Not all of us have the energy, the drive to run businesses. So sometimes you find yourself in a space where you've gotten money, you want to put it away into somewhere where you think it's safe. So in terms of requirements, what does someone need to have to buy a bond or bill?
Okay, first of all, have an active bank account with your commercial bank.
Okay, that's one.
So number two, when the moment you have an active account with your commercial bank, you're going to go to your bank and open up a very special account that is separate from your bank account. It's called a CSD account, Central Securities Depository Account.
Okay.
Now that account is special because it's the only account you can use to buy investments, treasury bonds, bills, stocks.
Okay.
Yeah. So the moment you've opened up your CSD, because they'll give you what we call a Form 1, all they will need is just your passport photo, national ID, and your tax, your TIN number. Yeah. The moment you provide that, within basically 24 to 72 hours, your account, your CSD account is out. Now there you can then approach an investment advisor. You can have a deep conversation with a person to align your goals and know which bond you would like to purchase, and then you can then go ahead and purchase that bond through your bank or your stockbroker.
Is there a limit in terms of how much I can put into trade?
No. So the minimum, according to the government, is 100,000 Ugandan shillings.
100K.
Yeah, 100K. You can start with 100K, and there is no roof. You can go as high as you want. But the whole point is on consistency. For guys with lower incomes of money, 100K, 2 million, 3 million, it is good that you either use a unit trust, or you could, if you go directly into the bonds, be consistent. That means keep topping up either every month or whenever you have money, so that you grow your portfolio over time.
You mentioned something interesting. So when you say topping up, does that mean every month I get to bid for a new bond?
Yes, you can do that. You can bid for a new bond, or you could, you see that very bond you're holding?
Yes.
You can always repurchase it in the secondary market. It's already there. So just go and buy more and more. It's like buying stocks or shares. Yeah? So they're already there in the market. You're just topping up on already what is existing.
Okay.
Yeah.
Interesting. So I'm meant to believe in the conversations we have that every investment has a risk associated to it, particularly for these government securities. What would be some of the risks that our viewers would have to consider?
Okay. The question I get the most is on default risk. Okay. What if the government defaults? And has Uganda ever defaulted on public debt or bonds? So, particularly on the answer of the government, Uganda, no. Uganda has not defaulted on public debt. One of the main reasons is that our debt is issued in our local currency. So it is very easy for them to either set up another bond, collect money and pay you off, or print money.
Yeah, true.
They can literally control the debt. But sometimes what can cause a country to default is them issuing a bond in a foreign currency and unable to pay it on time. Now, with a foreign currency, you cannot print a US dollar as Uganda. Yeah. So if anything happened and you're unable to raise that money on time to pay off that, now you're going to default, because now there's almost no other way. Either you're going to have to take on a bigger loan, or so it will become more complex. So we have seen it in other countries. We've seen it in other countries happening, but particularly in Uganda, no. Now, how default is usually taken is that the moment government misses a payment of a coupon, is that they will what they do is just restructure the payments. It's not that they have refused to pay you.
Yeah.
No? So they will come out and say, okay, we accept we have defaulted and we are meant to pay you on this date. However, we are in talks to pay you probably in the next 2 months, in the next 3 months. So you cannot hear that that the money disappeared. The risk that is there is that your money will come in a little bit later than you expected. Okay. The other risk that we have, that is very common, that I've seen a lot, is what we call reinvestment risk. Remember me saying that you can top up on your bonds, but I also earlier mentioned that prices of bonds change every day. Yeah. So you bought a bond at a certain price today. 6 months down the road, a lot has happened. We have had probably interest rate fluctuations, etc. The prices have changed. And the moment the price has changed, now when you're purchasing at a later date, you're going to find that probably that moment is not favoring you, the person purchasing. Yeah? So we also have that, but it's a bit minimal. It's not so much. The other risk that is there is that we have what we call liquidity risk. So yes, we know that bonds, a bank is obligated to buy the bond in case you want to sell it off. Okay? You can even have your money within the space of 3 days. It can buy it back. However, the challenge is at what price? Yeah? So you bought it at a certain price, but because you're selling it earlier, you're going to have to sell it at a loss. Yeah? But that's not always the case. Yeah? Most of the times, yes, you're going to sell it at a loss. But at certain times where the market flips towards your side, okay? That probably interest rates dropped and etc. So you find that now, since you bought it earlier, now you are in the higher bracket. So now they're buying it at a much higher price. So you find that some people, the timing is right at that moment for them to sell. Yeah. So that is where I'm saying that the investment advisor needs to come in and tell you that this is the right time to sell, or please hold. But if it's an emergency and you have no other choice, then go ahead, and because for it is you can easily flip the money. But to give people a little bit of context in the kind of loss they could expect, it really depends. But you could lose even to as much as 5-10%
of your investment value.
That can happen. Yeah, sometimes it can be at 3, at 2, depending even on your negotiation skills and who you're selling it to on the secondary market. You could find that you're selling it to your friend, and your friend decides, okay, let me give you a better price. Yeah. If you're able to find another person to buy it from you, you could negotiate better. But when it is on the side of majorly the bigger institutions and etc., it is business. They have to buy it cheaper from you. Yeah, so that you can also, make a bit of a spread on it.
So where does the taxman sit in all this? People are making money, money is exchanging hands. Taxman should be interested in that conversation.
So yes, it is an asset, it's an investment, so definitely you are taxed, what we call a withholding tax. Now, short-term debt, 3 months to 5 years, you're going to pay a tax of 20% on your income. So on your interest is what is being taxed. Okay? And then 10% from 10 years to 25 years in Ugandan context. So what happens is they're going to get the interest, the tax, for example, the 20%, and divide it into 2. So remember, you're being paid twice a year. So in the first 6 months, they will chop 10%. The other 6 months, they'll chop another 10%. So combined, it's 20% that you have paid. So what comes into your account is net of the tax. So everything has already been deducted. You're just seeing the net on your bank account.
That's interesting.
Yeah.
So I just want to understand something as we come to close to this episode. Treasury bills mature. The technicality between the treasury bond and the treasury bill, based off the tax element that you've mentioned, I've had treasury bills mature. At maturity, just elaborate more around the treasury bills structure.
Okay. So treasury bills, let me first define what a treasury bill is. A treasury bill is a short-term asset, loan. 3 months, 6 months, 12 months.
Yes.
Now, treasury bills and how they are auctioned into the public, they're auctioned as a discount instrument. Okay. So they're auctioned at a discount. They are discounted. Okay, the discount is what you'd want to call your coupon or your interest rate. So if they say that the 3 month treasury bill, we are giving it at 9%, okay, that means they're discounting it off as of that. Not that you are getting 9% as additional. It's a discount. So you're going to pay less, but what you're going to get after 3 months is equal to that.
9%.
Yeah. However, I don't want people to misunderstand.
Yes.
When the government says that we are giving out 9%, usually they're saying per annum. It's not that in 3 months you're going to make 9%.
9%, yeah. Okay.
Let them get this clear.
Okay.
So what happens is to just to make it slightly easier for people to get is if they say it is 12%, that means you're just going to get the 12%. You're going to divide it by 12 months.
By 12 months.
That means you're getting 1% per month.
Yeah.
In 3 months, that means you're getting 3%. Yeah, so that is your actual take home, not the actual, 9 or 12% that you're seeing there. Those are annualized returns.
That makes sense. So,
yeah,
I want to pick your personal opinion on this. From your perspective and looking at the market movements, do you think domestic debt financing is the way to go for us? I know, and I'm asking because I am privy to certain information based off the conversations we have day in, day out, but we are seeing lots of Ugandans running away from what you'd call the active or productive economy into government bonds and treasury bills. So what is happening, and this is my judgment, I would love to hear your own, what is happening is someone who has 500 million who would have set up a factory and employed 15 people, now picks that money and takes it to their commercial bank, like you've said, which is now the primary dealer for a bond. So in so doing, they've taken away jobs of about 15 people, the livelihoods of about 15 people. So whereas the treasury bonds have the positive side, which is the safety, you're guaranteed on returns, it is structured every 6 months, there's a bleeding economy on the side too. So I just want to pick from your own perspective, and I love how you started this. You started by giving us the 3 ways through which government raises financing money locally, globally or internationally from the IMFs and World Banks. Do you think it's a sustainable model to the push for government securities in our economy? As Uganda, in the Ugandan perspective, it's a young economy. You have very many graduates coming out who need jobs. We're having money being packed into passive investments. What's your take?
Seeing the trends, I'm just going to give you a trend from 2014 till today, 2026. 2014 to about 2023. Our biggest debt was on foreign debt, was held under foreign debt. But come down to today, the biggest debt the government holds is public debt. So over 52% of Uganda's debt is already public debt. That means the government has a lot of our money that we have lent it, over time. Now, one of the reasons that has happened is number one, we know that government bonds are literally government backed, they are safe. And number two is the consistency in the payments. They have not defaulted. That means they know that if I give you my money today, you're going to pay me on this date. You've already told me the dates in which you're going to pay me my money. You already deducted your tax, so I don't have to, get, headache over other payments to make. So all that money comes to me. Now, the other active investments are, you need to be hands-on. You have to pay, different, taxes and etc. to them, and a lot of people are also employed. They have other jobs they are running, so they can't be here and be the other side to control what's happening. So most of them are now branching into something they know they can just put their money, and they know everything else is taken care of. But is it sustainable in the long run? Yes and no, depending really. Yes, it is sustainable because the certain active investments that can never stop. Land, everyone needs land. It is part of almost everyone's portfolio, and people definitely need it. So under everyone's portfolio, we're going to have those assets that, if each asset plays its own different role. So it's not that I want to tell you that invest in treasury bonds, leave land. The question is on the when to do that, but you definitely need all those investments. So there are those active things like businesses, food, agriculture, etc. Those can never stop because we definitely need them. The thing is, how then can we use the government financing, the government borrowing money to then grow the economy in terms of setting up different infrastructures and jobs for our youth, and also educating them on different creativity kinds of jobs. So it's not like it will stop the economy from growing, but how then does the government then use the funds to
That
grow
we've collected, yeah.
the economy that we are in? Yeah.
Fair enough, fair enough. Thank you, Elijah. Your parting shots to our viewers. Thank you for creating time to come and share your knowledge bank with us. I'm sure someone today has learned something new from this conversation. So give us your parting shots. Yeah.
So thank you very much, Paul. It was an absolute honor sharing the knowledge that I have about government securities. And one thing I can say is it's not too late for you to start investing. And there's nothing like little money to start investing. Just start wherever you are and grow it, okay? But to grow, you can't grow alone. You definitely need partners, yeah? And that is where your investment advisors come in. That is where Paul comes in, is where I come in, and different, advisors. So please walk up to your investment advisor, have a deep talk with them on where you want to see your finances grow, and then have a structure, have a plan, okay? Same thing that happens in wars. For soldiers to win in a battle, there has to be a plan.
Yeah.
Okay? And it is the general that takes the credit. So if you're not a good general in terms of planning and you're just bumping into things, then it may not turn out that good for you. So have a solid plan and then follow that plan through.
Thank
So
you.
thank you very much.
So for me, I think my parting shots will not differ so much from what Elijah said. It's very important for you to, one, I have seen, like I said, there's a lot of information on the internet. We shall not come here and drive a narrative of telling you only go and invest in treasury government bonds. It may not be the right thing to do because everyone sees the sun from their own angle. So the bonds and bills may not be your thing, land may be your thing. What Elijah said is that in investments you'll always have different baskets. You cannot always have one basket. So your basket of investment cannot only be the government securities. You'll have a bit of land there, assets, property, you may be into business, you may be into the unit trusts, all those different investment options. You may be into the Euro bonds that we've not spoken about. We shall just get a specific day to delve into the Euro bonds. So from us today, I think we would love to thank you so much for being a part of this conversation. Thank you for always keeping it Pesa Talk. Ensure you share this episode with someone that is dear to you. Knowledge doesn't stop. The knowledge will keep flowing. We shall keep bringing you guests that will add onto your knowledge bank such that we are going to win this battle together. Maybe, Elijah, before we go, just one. What has been your one money mistake? What is that thing you did with money that was a mistake that you learned from?
Borrowing to invest. Borrowing to invest. No, that mistake, that thing actually taught me a lot. The challenge is we borrow expecting that the investment we're going to make is going to
work out.
It's good to have faith.
Yeah.
It's definitely good to have faith.
Yeah.
But at what rate are you borrowing at? And most of the times that you're going to borrow money and the rate is in double digits, it's very expensive compared to where you're going to invest this money. Yeah, I've had a lot of people saying, can I borrow to go into a government bond and etc.? Yeah. I'm like, if only if you are getting it way cheaper compared to what the government security is giving, you then go ahead. But if not, please do not. You'd rather build slowly, yeah. So borrowing to invest is not necessarily a bad idea, but how you actually get it is where the trick is.
Okay,
yeah.
You had it. Thank you. Until next time, I remain your host, Paul Businge. See you next time. Thank you.